Hello, I'm Rick Underwood, and this is David Walterman with the Reverse Mortgage Group. And today's question is, can you use the equity in your home to help pay for in-home care?
The quick answer, yes, you can. There are options, but if you're 62 or older, by far the best option would be a reverse mortgage.
It's very easy to qualify for a reverse mortgage.
Yep.
Just as you said, you only need to be 62 years or older, you need to live in the home, and you need to have equity in the home.
Yep. And some of the standard concerns with a forward mortgage, like credit scores, income, are typically not barriers for a reverse mortgage. So it's really easy access.
Because they're not qualifying the person. The home is the security on this loan.
Exactly.
So very easy.
So we're going to look at a real world example to see how a reverse mortgage could pay for in-home care. So we have got an 85-year-old widow. She has recently fallen a couple of times, and so now the children are concerned with her well-being. Of course, assisted living has been a thought, which is very costly.
Very expensive. And we look at that, and nationwide averages for assisted living facilities are about $11,000 a month.
Right.
Where if you were to stay in their home for in-home care, it's about $4,000, $4,500 national average. Considerable savings if you can stay in the home.
Either way, either option, it still is going to be a financial burden to the kids. Mom is on Social Security income. That's basically covering food necessities.
Right. So she's already depleted most of her reserves, most likely.
Right. But mom lives in a home and she wants to stay in this home. So that's very important. That's kind of steering their option to look at in-home care.
Which is very common. Most seniors, they want to stay in their home. That's their comfort level.
And it's proven to be safer for them to do so.
Yes.
So in her case, she's in LA County and her home is worth $822,000. The kids have determined that they've mapped out a 5-year plan. They've determined that they'll need about $250,000. So that's their goal. Can we get $250,000 to pay for in-home care for about 5 years?
Right.
So let's plug in the numbers and see if it works. Now, 3 things that really come into play when determining how much you can take from your home is your age, your home's value, and the county that you live in because of lending limits. So in her case, $822,000, her age, we've plugged in those numbers into our software, and she would have access to $412,644.
And to that point, it gives us a very specific number. When we plug in those digits, it's not a matter of us qualifying them. FHA, they will tell us exactly what this person
right out of the gates, we can, give a cheer. It looks like they're going to be able to meet their goal. Mom's going to be able to stay in her home. But just quickly describe and explain how a reverse mortgage works, because if she does this, she will not be making a mortgage payment.
Which is everything.
She's accessing the equity, but she's not making a mortgage payment. How does that work?
Right. And I think the best way to illustrate this is with a house.
This house.
So this is a house. No criticism, no critique. This is a house. I'm going to give it a door just so we even know it's a house. Okay. So what do we say the value was?
$822. And we know that the bank will give her access to $412,000. Let's just call it even. $412,000.
And the bank, once again, the bank's going to tell us exactly what her limit is, which she could borrow.
Right.
Okay, so that's the limit. They do not need to take that much.
Right.
But that's how much they'll give her access to based upon her numbers.
Yep.
And then she was going to draw how much?
They want to take out about $250,000 at closing.
Okay, so they start the loan funds, immediately they're going to have a wire. They're going to have $250,000 to use however they like, in this case, to help pay for in-home care for mom. So of that $250,000, that's the amount they're drawing. They still have access to the remaining amount, that $412,000. So what amount is in here?
And this is a line of credit, right? And it's compounding and growing, and that amount after closing costs about $136,000, $137,000.
So after 12 months, they have access to another
137,000.
You did say 130.
And this is basically a safeguard. You know, it's in place. It's easily accessible. It's like liquid cash at that point. You make the request, you can have access. So if something
just like
comes
any
along,
other line of credit, you can tap into it whenever you want for whatever reason.
if there's any home modifications that need to be done, it's an old house.
It is, and we talk about that most often when a senior's been in the home this long, long enough they paid off their home.
Right.
They've been in there 30, 40, 50 years, and so most likely, in addition to whatever modifications they'd want to make for improvements to make it easier for mom to live there, it may also need a new roof. It may need some major upkeep, some improvements that, once again, the children don't necessarily want to pay out of their pocket to do that. Mom doesn't really have the reserves.
That money can come from this area right here, that line of credit.
Exactly. They can use it after 12 months. They can use it however they like. So sure. So a lot of people ask, okay, well, how does a reverse mortgage work? They took this money out. If she's not making a mortgage payment, how does this work?
Yeah, it's magic.
It is. We'll show you the magic. So how it works, what the lender's going to do, as opposed to her making a mortgage payment, one way to think about it is it's as though she's making that mortgage payment out of a line of credit. So it's not coming out of her reserves. She's using the equity to service that loan. So that that original loan balance of $250 is going to increase a little bit over time, because what the lender's doing is they're assuming a little bit of the equity in her home. It's an interest-only portion. It's regulated. It's FHA backed. So they're going to assume an interest-only portion because she's not making a mortgage payment. I don't know how many times I can say that, but
that's
she's
the
not
beautiful
making a
thing. You
mortgage
can
payment.
say it all day long.
Right.
It's a beautiful thing.
That's the key here. So her mortgage balance is growing while they hold on to this mortgage, but at the same time, a lot of people wonder, okay, well, what about the equity, that sort of thing? At the same time, she's in an appreciating asset.
That's growing at, let's say, 4% a year.
Which
$822,000 at
Sure.
4% a year. Let's go out their 5-year plan. And mom's home is now worth $1 million. And $1,089,000.
Wow.
So her equity position is still favorable and solid, and she's had her needs met and has the security of a line of credit she can draw from. It's a win-win.
It is. And so because it's still an appreciating asset, they have more equity. The home is worth more. They have more equity after 5 years.
It's outpacing the loan.
Yes, exactly. Right. So it's almost impossible to use up the equity in your home.
Right. We'd like to point out the obvious fact that every situation is different. Yes. And we're here to answer any of your questions, and we'd be happy to plug in numbers for you to see if a reverse mortgage, can make the difference for you.
Right. Because for a lot of people, it is a lifesaver. It really is.
Literal life-changing. Yep.
So, we're the Reverse Mortgage Group. Give us a call. We'd be happy to run through numbers with you and see if a reverse mortgage is right for you.
Until next time, see ya.